Welcome to part two of the trading course. Okay. This section is going to be about technical analysis. The first thing you need to know about trading is your environment. This means looking at the higher time frames to interpret the smaller time frames, seeing the bigger picture to help understand the smaller picture. To do this, you need to pick a bigger time frame, such as the 4 hour, and then divide that by 10 to get the smaller time frame, which is 24 minutes. You can do this with any time frame, but for Bitcoin and Ethereum, this is the time frame that is most reliable for seeing the signals and has much bigger moves. Okay. And now the next step is to determine support and resistance. Support is a level or price point that a downward movement tends to touch and stay above. Resistance is a level or price point that an upward movement tends to touch and stay below. This just means places where price has a reaction of either to the upside or the downside. Use the Fibonacci retracement tool to find and clarify support and resistance points. To use the fib, pull from the local swing low to the swing high, or vice versa. So from the swing high to the swing low, you're looking at retracement levels. From the swing low to the swing high, you're looking for targets. So the most common target on the fib retracement is the 6.8 and the 6.5 pocket, called the golden pocket, because it almost always has a big reaction off of it, even on the smaller time frames. Once you have passed and closed a candle above a resistance, you can now use that resistance as support and vice versa. Just because you have a support or resistance doesn't always mean that the price will have a reaction. That's why you need to find confluence with everything else you're about to learn and practice proper risk management. Oh my goodness, I'm sorry for stuttering. Technical analysis continued. Trend lines are also another form of support and even sometimes resistance if you're in a channel. You can find trend lines by taking the trend line tool and connecting the wicks. Uh, you can also connect the bodies. Either way works, but I do the bodies more than the wicks now. A channel is just when you have a trend line above and below the candles. When a trend line is broken, either way, the price action normally moves the direction in which it broke. Trend lines are broken when a significant time frame closes and opens a candle below or above a trend line, and then a significant time frame is like an hour plus. It just depends on the pattern and how big it is. So we'll get more into that. There are a lot of patterns you can trade in the chart. Here are some of the most common ones that I actually use. This is the trend slash channel. This is very important because it just gives you a basic structure of where you're going, if that makes sense. If the price falls under this low, that means a trend can change. So you're looking for this to confirm. You're looking for it to break this low, come back up, retest, and then come back down for a trend change. So yeah, patterns. Here are some of the most common patterns that you'll see, and you can trade them however you please. I like to short here, long here, short here, long here, and then just hold those trades until it breaks either way. That is honestly the best way to do it, in my opinion. because you can short from here, comes down here, you take profit, move your stop loss to entry, and just wait and do it in every direction. So no matter what happens, you're going to be winning your trades. So you're going to want to go through the chart, yeah, and look until you can memorize these patterns by heart. This will take practice. The first chart you look at, these patterns will not jump off the page at you, but they are there. So if you look, you can see them. You can obtain targets by taking a trend line from the top of the shape and pull it to the bottom and put that at the point of the breakout, whichever direction it goes. The patterns with higher highs and lower lows are okay. Wait, yeah, you can obtain a target by taking a trend line from the top of the shape and pull it to the bottom of the shape, uh, and put at the point of the breakout, whatever direction it goes. The pattern with higher highs and lower lows are 66% more likely to break upward and vice versa. Here are some actual things in the chart. This is a head and shoulders. We got bam, bam, bam. You can see that it came down past this low, which was, I mean, obvious for this one, but it came past down this lows, came back up, bam, hit that, went directly to this target. And this is on the Bitcoin chart on the daily. So this one you'd have to wait for the daily candles, but that was a massive trade. Okay. Here's a descending triangle. Bam, 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 bam. Breakdown. And it even went further than that trade. But you can see it went bam, went up and retested it. Okay. How to trade patterns. Well, you can do it this way, but I think my way that I do it now is a lot better because I'm planting seeds. So wait for the breakout to happen. You can do that. Yes. That's like how you're supposed to properly trade them. You want to enter the trade at the beginning of its movement. When it comes back up and retests, I wanted to go back like hit right here. So yeah, how to enter trades with the Fibonacci tool. We'll come back to that and how to use the fib in the next episode.